A sole proprietorship and a corporation are two different business structures with distinct characteristics. Let's examine them. 1. Legal entity. In a sole proprietorship, the business and the owner are considered a single legal entity. There is no legal distinction between the business and the individual running it. The owner is personally liable for all debts and obligations of the business. A corporation is a separate legal entity from its owners, shareholders. It exists as an independent legal entity and can own assets, incur debts, and enter into contracts. Shareholders' liability is limited to the amount they have invested in the corporation, protecting their personal assets from business debts. 2. Ownership. The business is owned and operated by a single individual, known as the sole proprietor. The proprietor has full control over all business decisions and operations. Whereas, ownership of a corporation is divided into shares, and multiple individuals or entities, shareholders, can own these shares. Shareholders elect a board of directors to manage the corporation's affairs, and the directors, in turn, appoint officers to run the day-to-day operations. 3. Taxation. In a sole proprietorship, business income is considered personal income for the owner. All profits and losses are reported on the owner's personal income tax return, and the business is not taxed separately. On the other hand, a corporation is a separate tax entity, and it files its own tax return, to report its income and expenses. Shareholders of the corporation are subject to personal income tax on any dividends they receive. 4. Continuity and transferability. The continuity of a sole proprietorship is dependent on the owner. If the owner decides to retire, sell the business, or passes away, the business generally ceases to exist. A corporation can have perpetual existence, separate from its shareholders. The ownership of a corporation can be transferred through the sale or transfer of shares, allowing for continuity even if shareholders change. 5. Regulatory and reporting requirements. Generally, fewer regulatory requirements are associated with a sole proprietorship. The owner may be required to register a business name and obtain necessary permits or licenses, depending on the nature of the business. Corporations have more complex regulatory and reporting requirements. They must register with the appropriate government authorities, maintain corporate records, hold annual meetings, and file annual reports and tax returns. 6. Financing. A sole proprietorship may find it relatively more challenging to raise significant capital beyond the owner's personal funds or loans. Corporations have more opportunities to raise capital through the issuance of shares to investors, or by obtaining loans and financing from banks or other financial institutions. In reality, most small corporations have similar challenges as sole proprietors. Choosing between a sole proprietorship and a corporation depends on various factors, including the nature of the business, liability considerations, tax implications, and the owner's long-term goals for the business. It's essential to consult with legal and financial professionals to make the best decision for your specific business needs and circumstances.